Something strange is happening in the markets right now. If you look at the headlines, everything seems perfectly fine. Stock indexes are near all-time highs. Technology companies dominate the news, and many investors feel like the bull market will just keep going. But when you look beneath the surface of the market, the picture starts to change, because markets rarely send warnings through headlines. They send warnings through capital flows. And right now, if you pay attention to where the big money is moving, you start seeing signals that usually appear before major shifts in the market cycle. Most investors don't notice it, but today we're going to break down what's really happening and why the next phase could look very different from what many expect. Let's start with a simple question. If the market is doing so well, why are large institutional investors quietly rotating their capital? Because that's exactly what appears to be happening. When markets move higher, most people assume the entire market is strong, but that's rarely the case. Under the surface, money is constantly moving from one sector to another, from one asset class to another. These rotations are extremely important. Market leadership changes over time. Think about previous cycles. At different moments, we saw leadership from financials, energy, or commodities. The leaders always change, but investors often keep chasing the previous winners. Right now, we see signs of a potential shift, capital moving away from crowded trades into ignored areas. This doesn't happen overnight. Large institutional investors manage trillions. When they change allocations, the process takes weeks, even months. The early signals are subtle. Which brings us to the bond market. Many focus entirely on stocks, but historically, bonds anticipate economic changes first. They reveal expectations about growth and inflation. When institutional investors begin shifting toward longer duration bonds, it may signal expectations of slower growth ahead, not necessarily a recession, but a macro change. Another signal comes from market divergences. When different parts of the system tell different stories, the stock market might rise while fewer companies participate. This is breadth deterioration. The index looks strong, but the foundation becomes weaker. Historically, strong divergences appear near turning points in the cycle. Think of it like pressure building beneath the surface. Everything looks calm above ground, but the tectonic plates underneath are slowly shifting. Eventually, something moves. Let's look at some real-world examples. Look at companies like Palantir and SoFi. These represent the high-growth fintech and software sectors that many retail investors love. Take SoFi, for instance. It's a favorite for its disruptive potential, but look at the institutional volume. Are they buying the dips or distributing their shares during these rallies? Palantir is another great example. While the headlines focus on their government contracts and AI dominance, the price action often tells a different story about risk appetite. When institutional capital rotates away from growth tech into safer havens, high-beta stocks like PLTR are often the first to feel the pressure, even if the fundamentals are solid. So, if the macro environment is shifting, how do we build a resilient process? This is where strategies like the wheel come into play. It's about generating income while waiting. The wheel strategy starts with selling cash-secured puts. You pick a stock you actually want to own, let's say Robinhood, and get paid a premium to wait for a price you like. If the stock hits your price, you're assigned the shares. Then you move to step 2, selling covered calls. You're double dipping on income, premiums plus potential capital gains. This strategy is powerful in a shifting market because it allows you to lower your cost basis. Whether the market goes sideways or slightly down, you're still generating cash flow. For a stock like Robinhood, which has seen periods of consolidation, the wheel can turn a boring flat chart into a consistent income stream while institutional players rotate. It reminds us of a core principle. The future rarely looks like the recent past. Strategies that worked in zero interest rate environments might not work in the next phase. This highlights the importance of diversification. When macro environments become uncertain, portfolios concentrated in a single theme become much more fragile. Focus less on predicting every move and more on building resilient processes. Combine diversification, risk management, and an awareness of these subtle macro signals. Right now, the market is sending those signals. Capital rotations, movements in the bond market, and divergences across sectors. Together, they suggest a new phase. Investors who recognize these shifts early have a significant advantage. The biggest opportunities appear not when the trend is obvious, but when the transition is beginning. If you found this breakdown helpful, make sure to hit the subscribe button and join our community as we navigate these market shifts together. Thanks for watching, and stay focused on the process. See you in the next one.